All right, this is chapter 3. So, trading breakouts with options, strike price, expiration date, price targets, and then risk management for options because that's going to be a lot different than risk management with shares. We're going to use two examples for this. So, Nvidia, we'll use this for an example because this was my biggest options trade. What else was big? Mara was big. Okay, so we'll use Mara, Nvidia, and then Carvana. Carvana is going to be the more complex one. But let's just get started with Nvidia. So why I traded options on this and why it worked so well. All right, if you open your broker, so let's open my broker. Let's go to Nvidia, and we look at Nvidia. We go to the options chain. So if you scroll over like to the right a little bit, you're gonna see this. I don't know, depends on what broker you're on, but you're gonna see the options volume. So the volume here on Nvidia, you can see 1 point or like the closest one to the money, the one that's just right out of the money. So strike price is 420 and stock price is 416. These have 116,000 volume with 9K open interest. So the volume is realistically the most important here. And then you can see the bid and ask spread is just $1 away. So, I mean, these are really cheap. It's 0.01 versus 0.02 is ask. But you can see like bid ask spread on these aren't too bad. Actually, when you go up higher, it's pretty fucking bad. But either way, there's enough volume here. You're not going to run into any issues. And then if we go to Mara, you can see that the volume on these is like 12K. So, you know, there's a decent amount of volume. Just make sure there's some fucking volume, please. Like, there shouldn't be no volume on the contract. So there shouldn't be like 100 volume. More than like 1,000 or something like that. Make sure there's some volume on the contracts. That's basically all I got to say. The larger caps, they're going to have volume on the contracts. Like Nvidia, Apple, Tesla, AMD. You know, it should be pretty obvious. If the stock has a lot of traded volume, like shares-wise, it should have a lot of volume in the options chain. But yeah, so here, right, we didn't have a price target for Nvidia. This was up a shit ton. This made this big move up. And we're looking for it to make another move up, right? What do we do? So this was, what day was this? 7/12. 7/12. What day is 7/12? Who knows? July 12th. That is a Wednesday. So we have Wednesday, Thursday, Friday. The first 3 to 5 days of the breakout are going to be the strongest. So because this broke out on Wednesday, I actually took them here, but let's just go with the breakout. Because we took this on Wednesday, because it broke out on Wednesday, our contracts are going to expire on Friday. That gives us a perfect window for the first 3 days of the breakout, which, as you can see, those were the strongest. The first 3 to 5 days are going to be the strongest. In this case, the first 3, that set the high for Nvidia. I'm pretty sure that was literally all-time highs. Okay, never mind, idiot. Either way, you get the point. The first 3 to 5 days are going to be the strongest. So the first 3 days are what we traded. And looking at this, you can see this made a 12% move, basically, from open to high. So how do I know that this is going to make a 12% move? Why would I select my strike to be 12% higher than breakout price or like opening price, you know? Because if we were to look at the average daily range, it's 3.45. I think at the time it was closer to 4. It is slowing down. In the next 3 days, if I expect like the next 3 to 5 days for this to be a breakout and my options expire on Friday, I'm buying them on Wednesday. I know that I have 3 days until these contracts expire. So I'm going to take the average daily range and multiply it by 3. It's that simple. So all I did was take the average daily range, which was about 4 at the time, multiply that by 3. That gives me 12%. You can end up getting calls way up here, 480 calls, which are going to be basically like a penny. And you can load the fuck up on those and make a shit ton of money. I don't know what call. I think we went with 460 or something like that, which people are like, oh, it's not going to hit 460. Let me see really quick which ones we actually went with because they were just so cheap. It was like I didn't want to go too much further out. I was like, I'd rather just let them be in the money rather than not. Let's see. Nvidia. Oh, so we went with 460 calls. Let's see. Can you guys see this? I guess it's inverse for some reason. What the fuck? Anyways, 8,455% off a 12% move. Insane, right? So that's an 85 to 1 trade. Yeah, so that's basically what you do. So we went with 460s. Like I said, the reason we went with 460s is because it was Wednesday. Options expired on Friday. If you're buying contracts, I bought them this day. So if you're buying them this day and you say, hey, I think this is going to go up 460, I think this is going to go up 8% by Friday, they're going to look at you sideways and be like, sure, bro, take the contracts for cheap. Me, I'm like, yeah, I'll take them. They don't know. I'm catching this breakout. But, if you're buying them on this day, they're going to be worth a little bit more already. I think they opened up like 200% higher or something like that. But I did end up adding more on this breakout as soon as the 5-minute opening range highs were taken out. And so that is realistically when you should take profits. If this is up like ADR, so if this is up, ADR was 4. If it's up 12% in 3 days, that's like maxed out on ADR. Take your profit there if you don't have a price target. If you have a price target, wait for the first price target, sell half, and then keep the rest, see how it acts, and then sell the rest. But I'll show you an example on that. Where were we? So, yeah, I mean, basically just multiply the ADR by how many days left you have on this contract or how many days until expiration. Trade the breakout that way. Typically, your expiration should be within a 3 to 5 day window. So if the stock's breaking on a Monday, you obviously are going to buy the calls for Friday because that's when they expire. You're not going to, this isn't SPY. You can't get 0 DTEs on a Tuesday or something like that. But basically, that's how it works. If it's breaking out on like Thursday or Friday, it might be a little bit more difficult. Friday, you could play a single day move like Carvana, where we played the single day move on this one. Now, what day was that actually? That was 9/14. 9/14 was a Thursday, so it wasn't bad, but it hit our price target, or just about. Oh, Jesus. So if we go back and we look at the 3,700% trade, or no, let's go to Mara first. So if we look at Mara, right, it's the same setup. It's really simple. Setup here was big move up. This made a 68% move up. Price went sideways. As it went sideways, this volume is dying out. It's very clear here on Mara that the volume was dying out. And then it broke out, and I bought it this day. Bitcoin also had a setup. So that was really important for Mara because Mara follows Bitcoin pretty closely. So that was really important. That just comes down to the context of the market, and you'll understand that as you start to trade this more and like start to join my lives, watch more of my videos, whatever. Or if you're in the Discord, I mean, you can just follow what I do. But anyways, you'll understand the context of the market and you'll understand how to do that as time goes on, as you get more used to this. But for the basics, like if you're buying the breakout here, Mara has an 8.6% average daily range. So if you expect 3 to 5 days that you're going to hold this, let's say 1, 2, 3, 4, 5, 5 ended up being a really high day, and you're buying it right here, you have this made a 40% move. So what's 40 divided by 5? 40 divided by 5 equals 8. What do you know? Perfectly the ADR. So multiply the ADR by how many days you have left on the contract. And if you're buying contracts, like let's say this is Friday, let's say, which I don't think it is, but let's just say this is Friday and you have until next week, then you have so many days. Just calculate the first 5 days. Expect 3 to 5 days in. Multiply the ADR. Pick one of those. You can pick 3 days. You can pick 4 days. You can pick 5 days. But if you're going to pick 3 days, then multiply the ADR by 3. If you're going to pick 4, multiply it by 4, right? And, you get my point. So that would be how I pick my strikes when I don't have price targets. And then expiration date is just going to be, within a week or two. But here we can clearly see that there's a price target. And I spotted it again. So it's right there. The reason why I choose... Can you guys see this? Oh, shit. Alright. Okay, so the reason why I choose this price target right here is because this comes up. Look, there's a setup right there. Volume dies out, breaks out, high volume. What do you know? Makes a big move up. Anyways, there's another setup right there. So you can see that the price, when it made this move up, it came down, struggled, came down, struggled, came down, struggled. Over and over and over. It bounced along this line multiple times. You can see that there's multiple touches along this line. It's very obvious. And then this is really close to the camera. But going into this, you can see it had the same problem at this price level. Bounced along this 5, 6, 7 times, whatever. Came up, came back down. I don't know what that gap is, but then came down again. Bounced up a little bit, couldn't get above there. Came back down, bounced up, couldn't get above there. broke through, came down, had more touches here, and then it was just like pretty obvious right there. And then if we look back, you can see that there's some chop back here as well. Yeah, I mean, this is another price target area right here. We have this white line, which, as you can see on this breakout, it ended up hitting that. So if we take this, you can see this really tight consolidation here. And then we identified that price target because of the multiple touches here, blah, 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 blah. You get the point. It breaks out. It takes super long, so you would have been in shares, not contracts. I did trade contracts on this to this strike again, though, which I'll show you guys in a second. But yeah, I get my price target. So if you have a price target that you can identify, then set your strike at that price target. And if your price target is more than 5 times the average daily range away, and your contracts expire soon, like it's not going to hit it by that time. So don't expect that it's just going to fit your time frame. Like if this is Wednesday, if this is breaking out on Wednesday and you have a price target that's, 5 times the ADR away, don't expect that it's just going to make that big move in 3 days just because that's when breakouts are strong. You still have to give it like 5 days. If ADR is, or if your price target is 5 times the ADR away, then select a contract that's going to be 5 days out. If not, what you're going to run into is like you're going to make a little bit of money. It's going to go up, but then you're going to get fucked because it doesn't get near your strike. And when your contracts are too far away from your strike and too close to expiration, they just go pretty much worthless. You're going to fuck yourself over doing that. But then this one, you can see again, I believe 6:20. I don't know if that was a Friday or not. I'm not a calendar genius. But anyways, if this was Friday and you take the breakout, that would have been pretty lucky because that's 2 times the ADR. Let's see, 6:20. I really don't remember. I did take this though. I remember that. You'd get really lucky if you ended up taking this and that moved in that day because you really shouldn't expect it to go much above ADR that quick. But yeah, I mean, just set your strike price at your price target and make it make sense. Don't expect it to make a huge move in 1 day. Don't expect it to make a huge move in 2 days. Give it some time. Like, be logical with it. And if you can't be logical with it, well, then that sucks. You're going to lose money. Yeah, I mean, I post literally all my trades on my Twitter, pretty much every single one. So if you're going to, if you have problems with it, just watch what I do and get the hang of it. But that should make sense. If it doesn't, I don't really know. Let's go over to Carvana because that would just be better. Okay, so Carvana, where was this day? This day is right here. So when you have contracts that expire quick and you don't know how long this run is going to last, you can zoom in on time frames. So let's take a look here. Now Carvana, if we were to mark out a price target right here, because this came down, touched there perfectly, came down, kind of touched there a little bit, came down, touched there again, struggled here, and then struggled getting back above it. So that was a clear price target right there. And this hit it pretty much to the penny. But this from breakout was a 170% move. So that happened in 6 days, which is like, okay, what the fuck? That's insane because Carvana has a 8% ADR. I think at the time it had more like a 13 or 14% ADR, but that's still insane. So what I did with this one was I bought the breakout here with options. My strike was just like pretty far out. Like I just chose. I didn't go off like ADR like that. I mean, you could have. Let's say this was like a 45% move. You could just multiply the ADR by 3. Expect to hold this for 3 to 5 days. If it continues to go, then it continues to go. But here I ended up taking some profits, and then, or it was on this day, I guess. And then if we look at the hourly chart, you get the same setup. So this goes up, sideways. As it goes sideways, this volume dies out here. And then it breaks out on the hourly right there. And the volume comes right back in. So this was the 3,700% because now we had a clear price target. And we knew that this was already on the move. Now we have our clear price target. Boom. We select our, what is that, 19 strike? Let's see, Carvana. Carvana, 3,700%. Where is it? Oh, I got 17s. Even better. What do you know? So I had 17s. They went in the money. This is flipped, obviously. We figured that out earlier. But you can see. So for that, it's kind of like the same thing as NVIDIA. If they're too far out of the money, because you'll see on the options chain, like if they're $1 each, like the ones below that are still going to be $1. You might as well just buy the ones above that. Or if they're really cheap, like $3, and the ones below that are still $3, it's like, bro, just get the ones above it. Or if it's not that much of a difference, you might as well be closer to the money rather than further away, because it'll just help you out. But yeah, that's like you can hit your price target super easily. These stocks will make big moves very fast, especially when they have relatively low market caps and high ADRs. So don't be shy. Don't think that it's not going to happen. And then when it comes to your entry, so your entry is going to be the same as entering the breakout with shares. First 5 minute, you wait for that, and then you enter on the highs, stop loss at low a day. But with options, you don't calculate your position size like that. You just put 1% of your account into the options, because if this gaps down on you tomorrow, like let's say you take breakout, it gaps down tomorrow, they're fucking worthless. You're toast. You can't even sell them. So you might as well just put 1% of your account in, because if it gaps down, or if it's hit, even if it hits stop, like most of the time they're going to be pretty worthless, because we're playing pretty close expiration dates and pretty far out of the money. Just put 1% of your account in, or less if you can afford to. A lot of the times I've been trading with like 0.5% lately, or even less, like 0.25%. But 1%, just keep it to that max. When it comes around and the market's good, like it used to be, we can go with that 2%. But you got to be careful. You really, really got to be careful, and you have to know what you're doing. Okay, what's next? What else do we have? So you guys understand what just happened. You guys understand risk that price targets, right? You guys understand how to find these price targets. You just look back in the chart. Where did it struggle? Where did it have support, resistance? And then picking your expiration date. It's like, that 3 to 5 days out, just multiply the ADR. Pretty simple. And then, yeah, expiration date's going to be 3 to 5 days out. Strike price is going to be at your price target. If not, multiply it by the ADR. And I don't think you can get much more simple than that. It's going to take some time to get used to, and it's going to be like a lot of discretion. Over time, you'll figure it out. Like, if you don't figure it out, you probably shouldn't be trading, because you must have a really, really low IQ. It took me, I'd say, like a year or two to figure it out. So I just gave you all the info that took me a year or two. I gave you this whole layout. I gave you this whole strategy. I'm giving you everything. I'm saving you guys a lot of time here. So if it doesn't work tomorrow or the next time you try it, who cares, bro? It took me years. So even with the right information, it's going to take you time to learn, because you're going to have to go through it, and nothing is going to teach you better than experience. No matter what I teach you guys, it's like, it really won't matter until you go and try to do it. All right? Then you'll figure it out a lot quicker. But then you'll have that resource to come back to and be like, all right, here's where I'm fucking up. Let me go watch that video again. All that stuff. But yeah, how long has this been? 18 minutes. Jesus. Yapping. What is next? All right. Part 4 or chapter 4, whatever. Scanning for setups, market conditions, sector rotation, and setup selection. Bad setups can be good if in the right sector. I'll show you guys all about that, because the context of the market plays a really, really big role in how you're going to be trading. Also, like when to trade versus when not to trade. So yeah, I'll see you in chapter 4.